Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Today I want to talk about something that matters more than almost anything else in investing: cycles. Because markets move, conditions change, confidence rises and falls, capital flows in and out, and over time one thing becomes very clear. It's not the investments that perform well in good markets that matter most. It's the structures that hold together in difficult ones. Property is not a straight line market. There are periods where demand is strong, liquidity is high, development is easy, and there are periods where financing tightens, sales slow, confidence drops. Most strategies are built for the first environment. Very few are designed for the second. When markets shift, the same weaknesses tend to appear: over-leveraged projects, dependence on external funding, tight timelines with no flexibility, and decision-making driven by pressure rather than discipline. And when those elements combine, good projects can still fail, not because the opportunity wasn't there, but because the structure couldn't adapt. At change.Capital, the model hasn't been built around perfect conditions. It's been built around the idea that markets will change, and when they do, the structure needs to absorb that change. That's why the focus is on smaller, more liquid housing schemes, shorter project durations, diversified capital deployment, and disciplined investment selection, because those elements create flexibility. One of the biggest differences in this model is control. By structuring both debt and equity within the same framework, the platform is not reliant on third-party capital providers making decisions under pressure. That removes a major source of instability, because decisions remain aligned with the project, not external constraints. Governance becomes even more important when markets are uncertain. The investment committee structure, with clear separation between origination, underwriting, delivery, and independent approval, ensures that decisions remain disciplined even when conditions change. That consistency is what protects capital over time. The type of projects we focus on also plays a role. Smaller housing schemes, typically under 20 units, shorter build and sale cycles. For example, the base case project operates on an 18-month timeline, 12 months to build, 6 months to sell, which allows capital to be recycled more quickly and reduces exposure to long-term market shifts. This is not about chasing the biggest developments. It's about maintaining control and flexibility. Another key element is how the platform generates income. Revenue is not dependent on one event. It's generated at acquisition, during the project life cycle, and at exit, from fees, interest margin, and profit participation, which means the business itself is not reliant on perfect exit conditions to function. When you bring all of this together, the model behaves differently. In stronger markets, it performs. In more challenging markets, it adapts. Because capital is controlled, decisions are structured, projects are repeatable, and risk is distributed, and that's what allows it to continue operating through different phases of the cycle. So when evaluating any investment platform, it's worth asking a simple question, not how does this perform when everything goes right, but how does this behave when things become uncertain? Because that's where structure matters most. Thanks for listening, and remember, markets will always change. The only question is whether the structure you're investing in is built to handle that change. I'll see you in the next episode.